So let's deal with our ranged reality. Now, you might ask, for heaven's sakes, why would markets always want to stay within a range? Well, markets come into a range for various reasons, right? You can see. The first one is because sometimes the swings that you see become too exaggerated. When a stock price climbs up too much, try to understand that you are not the only buyer there. There are many people who bought that stock a few days ago, a few weeks ago. And as you accelerate the movement upwards, you're giving those people time and opportunity to take that profit. You might be entering now, but these guys are making tons of money. And if they're making tons of money, they can easily sell that. And that creates that cap and produces that reactive effect or sideways effect into the price. Second, trend transition. So sometimes it's the intent of a particular stock price to do one of two things. They go up because of exaggeration, they start to park, and as they go sideways, they're here telling you that after this, I'm either going to go back up again or I'm going to turn around and I'm going to head back down. So it's a pause point. The market needs to make a new decision. And as it's making that new decision, it creates this characteristic sidewinding range. And that one is something that can prove useful if you know what to be able to look at. We'll talk about that later when I deal with the area patterns. The third is fixed discrepancy in terms of being too expensive. This is not a fundamental talk, but I'm just giving you reasons why sometimes prices need to range. So for example, stock price goes up. It goes well beyond its fair value. And now it becomes quite expensive. Even the fundamentalists think it's expensive, and you're going to get a lot of profit-taking maneuvers coming into that. And that's a reason that you will also get some adjustments. People who are new are going to say, why would I buy that? It's kind of pricey. I'll buy some other stock. So automatically, there'll be less demand heading in that direction if the value proposition is not there. And last, the loss of demand or the loss of supply can also create these ranges. Why is there a loss of demand? It could not have anything to do with the stock. It could have everything to do with something else. For example, like Edward said, a crisis. Good company in a crisis, not too many people is going to want to buy that. Right? Because people become more risk averse. They say, oh, baka ito mangyari sa akin, so why am I going to buy this now? I'll stand back first, wait to see what happens. Automatically, wala na dun yung pangbili ninyo eh. And that will also cause a pause movement into price. And these are the reasons why you will see a lot of trading ranges attempt to appear. So, as an example, this is swing exaggeration. So, you get prices moving up very, very sharply. And as you see that the movements, for example, what you're seeing from this end down here all the way up to this area up there, very, very fast, and then prices just stop dead on the water, and then they start to cascade sideways. It creates a pattern. We call that a falling wedge. And that pattern attempts to pause prices for a while, but eventually prices rise back all over again. Right? And then shoots up, stops, cascades sideways all over again, and then pushes up once more. Wouldn't it be great if somebody could just look at something like that, someone like you in the back of your mind, who can just tell you, no, you enter just on this moment. Don't enter during that entire sideways moment. Because if it takes 3, 4, or 5 weeks to go sideways, that means you're going to have spent 3 or 4 or 5 weeks holding your stock, hoping it goes up. Imagine if you've been waiting 3, 4 weeks and then bumaba pa. And that's the worst. So what you want is to be able to make sure that you're in line with that it can still continue to be able to move higher from that particular movement. So remember, swing exaggeration will pause for a while. Trend transition. Here you have a downward moving chart. All of a sudden, it creates a base. Goes sideways for a while, and then eventually punches over resistance, and you have prices attempting to move on. So this particular type condition, you have to understand, happens because it takes time to turn a trend around. So if you have a strong upward moving market, before it starts falling down, that market will stop, turn sideways, cascade first, and then turn downwards. So remember, that works for many of the chart. I would say 90% of the time, that's what happens. The only reason you would get something out of that is when something completely spontaneous, maybe damaging or very buoyant to a company price that might be involved. And that's the only time you get something out of the normal. Okay? Next. The difficulty of you trying to figure out, is this expensive or not? Well, fortunately, we do have an investment guide. Some of the fair values of stocks are placed there. So if you want to be able to try to look for propositions in value, you check. So for example, BDO. Earlier, broke out 2 days ago, went from 133 pesos per share, 134, shot up all the way up to 140, 142 in 2 days. And then we get some pressure into the selling side. Its fair value is 130 pesos per share. So right now, BDO is not cheap. Yet, why is it moving? Right? There could be something else that's causing that instability to the price. But the minute whatever reasoning stops, it's going to eventually try to seek its way closer to that fair value. And that's why you're going to get gyrations and sideways movements into the price eventually. And, of course, the loss of demand or supply. So I think, look at this picture that you see here. It falls down, goes sideways first. Goes up, goes sideways, and then goes back down. And that's a clear example of how these transitory positions normally attempt to be able to move on. And you just have to be prepared for that. The learning lesson here is this. Once a pattern ranges, your style has to change. You become a bit more defensive because the market is not aggressive. And as it's figuring out what it wants to do next, you have to hang back and say, all right, I'm going to wait here on the sidelines unless there is an opportunity to make money in that range. And we'll talk about that in a little while. But in general, if that range particularly is very small and there's no way for you to make money, you hang back and wait for it to tell you what decision it's made.